This session will cover financial management and budgeting. I'm Pam Anglin, President of Paris Junior College. I'm going to provide a brief overview of a board member's financial responsibilities and talk a little bit about the community college revenue stream. Van Miller, Vice Chancellor of Fiscal Affairs at North Central Texas College, will discuss budgeting, and Terry Zamora, Vice Chancellor of Fiscal Affairs at San Jacinto College, will introduce you to financial ratios and financial indicators. Included in the legislated responsibility of the community college board member are setting tuition fees for the institution, management of college district funds, approving an annual budget, selecting an auditor for an annual audit, selecting a depository institution, and setting tax rates and approving the sale of bonds. Community college revenue comes from three main sources: tuition fees, property taxes, and state appropriations. The percentage of reliance on each of these sources differs among the 50 community college districts. Much of it depends on the tax base of a particular community college. It typically determines the reliance on tuition and fees and state appropriations. State appropriations are determined by the legislature every 2 years based on a funding formula. The state appropriations formula for community colleges is divided into three funding categories: core operations, and currently each community college receives $1,360,000 over the biennium to cover core operations. A core operation is those basic operations needed at every college. And then success points. Colleges receive funding based on metrics leading to student success and completion, which includes progressions such as completing 15 credit hours or 30 credit hours, and for credentials such as a certificate or an associate degree, and for university transfer. And then contact hours. Contact hours are based on seat time or the time assigned to the completion of the course. For example, a 3 credit hour course over a 16-week semester generates 48 contact hours for each student. Then funding would be based on the total contact hours generated by an institution during its base year or counting year, and we're currently in the middle of a base year now. Each year, each community college submits a report of fundable operating expenses to the coordinating board. These reports are compiled and a cost of instruction per contact hour is calculated. These cost rates are used in determining the contact hour funding total. We're not funded at 100% of this cost, but this provides an allocation tool for the amount allotted by the legislature during each legislative session for that contact hour funding. Every other year, the Higher Education Coordinating Board appoints a Community and Technical College Formula Funding Advisory Committee. This committee addresses charges from the commissioner, including preparing a formula funding recommendation for the next biennium. The recommendation of the committee goes to the commissioner, and the commissioner may agree with the committee or submit his or her own recommendation to the coordinating board members. The coordinating board's recommendation then goes to the legislative budget board and the governor's office. Ultimately, the funding is decided on by that legislature during that legislative session. I will turn it over to Van Miller, who will talk to you about the budgeting process.
Hello, my name is Van Miller, Vice Chancellor of Fiscal Affairs at North Central Texas College, and I want to talk to you today about the budgeting process for community colleges here in the state of Texas. And I think the most important thing that we need to know is that by statute, We are required to have a budget in place by September 1st of each and every year. So the first day of the fiscal year cannot begin without having a budget in place for the college. And the budgeting process at Texas community colleges is an extensive process, and it usually takes about 6 to 8 months of planning. In order to be ready for that September 1 deadline, most colleges begin early in the spring semester, maybe in January, but I would think most schools, definitely by the time spring break rolls around in March, has begun the budgeting process. Part of this makes sense because many of our faculty in the instructional areas, of course, they typically work through the middle part of May, and then they do have summers off. So if we want input from these instructional departments, we have to make sure all that is done while the faculty are present on campus during the spring semester. So it is extensive. It lasts 6 to 8 months throughout the year. I want to first look in on the revenue side of the operating budget. And as Dr. Anglin said, there are 3 primary sources of revenue for Texas community colleges. Oftentimes we refer to our financing structure as a 3-legged stool. And these 3 major funding sources make up those 3 legs on that stool. So let me go over each of them with you and some of the impacts or things we have to consider as we try to budget for a new fiscal year on these different sources of revenue. First of all, we can look at state appropriations. And as Dr. Anglin said, it is something that is done every other year. Our appropriations are generated. And so when we're in an even year like we were this year in the year 2020, state appropriation projection was quite simple because we were entering the second year of the biennium. We have known for well over a year what our appropriation would be. So there is no change. We know that in an even number year. However, on odd number years, like 2021 coming up, we're in the midst of a legislative session all during the spring semester while we're starting our budget. Typically, the legislative session will end around Memorial Day. So in most bienniums, we will know by the end of May what our appropriation is going to be for the upcoming fiscal year. But sometimes the legislature goes into special session. And when that happens, our appropriation gets drug out into the summer months. And we start, in some cases, pushing that July, August timeframe, and we're trying to get the budget completed by September 1. So sometimes that can be a concern for us. Now, many schools may actually have the board vote on a budget before the exact amount of state appropriations is actually known. Some schools like to complete their budget process early in the summer, May, June timeframe. And then if a revision needs to be made later on, they will take care of it in that manner. But in an ideal situation, we'll know what those state appropriation revenues are going to be by the time the budget is created. The next area is local property taxes. And there's some terminology that everyone needs to understand on setting property taxes. For years, we had dealt with the effective tax rate and the rollback tax rate. There's been a change in terminology that came about during the past legislative session. Now we talk about the no new tax rate. This is the tax rate that will generate approximately the same amount of revenue that we received the previous year. The rollback rate is now referred to as the voter approval rate. So this is the rate, if we go over that rate, we have to take it to the voters to be approved. And for community colleges, that voter approval rate is 8% over the no new tax rate. Now, final valuations on property are typically not known until late July. And in some cases, even by late July, they don't have exact numbers because the sheer volume of protests that go on, that can delay the situation. So some large county college districts end up having to rely on projections in order to set their tax rate. So that's a concern for some of our schools. And also when we're moving through a year where we have a weak economy like we're in now because of the pandemic, a lot of schools who are very reliant on property taxes are now concerned about the collections rate. With so many people unemployed, with businesses that are in such financial trouble, will we get that typical 98 to 99% of the estimated taxes, or will the weakness in the economy lead to a lower percentage of collections? That's something we have to factor in and take into account when we try to set our revenue projections from property taxes. And then lastly, the last leg of the stool is tuition and fees. And typically, most schools, I believe, do set tuition and fees in the spring semester because during the month of April, we typically have to submit to the Department of Ed what our official cost of attendance is going to be. And tuition and fees are a major component of that cost of attendance. So even though the budget's not being completed in some cases until August, tuition and fees are often set by the board in February, March of that year, well before the actual budget is finalized. Now, I do know some schools will go entirely through the budget process, and then during the summer, as they're completing their budget numbers, they will at that point in time set tuition rates. But at that point in time, they're so close to the fall semester beginning, those rates usually won't take effect until the spring. But if you do it that way, then technically you have to go back and then adjust your cost of attendance for the remainder of the school year, have to adjust that number with the Department of Ed. But many schools do choose to do their tuition and fee rate setting in that fashion. Ideally, this three-legged stool, these three sources of funding would be virtually equal and of equal importance to schools. But I want to show you that for most of our schools, that is not the case. And so I want to give you several examples of revenue distributions that you might find at colleges throughout the state. And this distribution of revenue can have an impact in the budgeting process on which of these sources of revenue might be most important and take the most time in creating an accurate budget for your institution. My previous institution where I served in Temple at Temple College, I knew their situation. So, I thought here that they are a pretty good example of a school that has a pretty equal distribution between state appropriations, local taxes, and tuition and fees. All of them within 10%. So you could say their three-legged stool is pretty equally balanced. And so they have to pay attention to all three of those funding sources very closely in the budgeting process. Now, we look at some other schools, and I took two schools here that at first glance seem to be polar opposites of each other. College of the Mainland, Collin College. Collin College is 5 times the size as College of the Mainland. And so you think these are two disparate examples, very different. But when you look at their revenue distributions, these two are quite similar. You see that in here, they both have over 50% of their revenues coming from local taxes. So in the budgeting process, it's quite important. These guys really have to focus in on the local taxes because that is the overriding and main source of revenue for their institution. And then let's take one last example. My current college, North Central College, is about a third or two. I guess Blinn College is about 2.5 to 3 times the size of North Central Texas College. Again, they look to be quite different, right? Well, from revenue sources, they are quite similar in that well over 50% of their revenue comes from tuition and fees. So these schools have to place a tremendous emphasis on setting and accurately setting that tuition and fee number that will generate the revenues they need for the upcoming fiscal year. So this just shows you some widely different examples of what different community colleges in Texas are facing when they're trying to set their budgets for the upcoming fiscal year. Now we'll quickly turn to the expense side of the budget. And over here, without a question, the largest category of expense for all community colleges is employee salaries. We are very heavily focused on employee wages when it comes to our budget allocations for expenses. And historically, community colleges are not known for having great salaries for our employees, but we definitely make up for that with the benefits that we provide. In fact, our benefits are quite envious from other employees, from other employers. So the institution's cost to provide those benefits can easily range from 25 to 35% of the total salary budget. So it is a significant cost to the community colleges and something we have to focus in on very closely when we set our budgets for the upcoming year. Another interesting thing about community colleges is that our part-time instructor salaries, which are sometimes for adjunct faculty, sometimes it's overloads for full-time faculty. But these part-time salaries can create a natural buffer in the budgeting process. For instance, when we face something like we're in right now with the pandemic, our enrollment here at my school dropped about 12% from the same time last year. The budget process, we know that our part-time instructor salary budgets are going to go down drastically because of our lower enrollments. So yes, we get less revenue, but that drop in revenue is somewhat offset by the drop in part-time instructor salaries. And the same thing can happen when we go through times of enrollment growth. We may not have thought we budgeted for a 10% increase in students for this next year. But if we do get that 10% increase, we know we're going to have a significant increase in tuition revenue that will help cover those additional instructor salaries that are necessary to meet those classroom demands of the additional students. And finally, there are some typical cutbacks that community colleges try to utilize during a budget crunch like we see right now with the pandemic. And honestly, these cutbacks are not very different from what you find in most industries, but it's very typical for schools to cut back on travel and professional development. We also tend to cut back on deferred maintenance, and we also cut back on new capital purchases, delay them. Hopefully next fiscal year, financial situation will be better and those things can be taken care of a year down the road. That basically concludes my presentation on budgeting at Texas community colleges. And our next presenter will be Ms. Terry Zamora from San Jacinto College.
Hello, I'm Terry Zamora. I'm the Vice Chancellor of Fiscal Affairs at San Jacinto College. And today I'm going to talk to you about different financial ratios and indicators that are important to community colleges. Financial ratios and indicators generally serve to measure the financial health of our community colleges in a very broad sense. But they may also be used to compare against benchmarks, facilitate comparisons between colleges or facilitate comparisons over time. As discussed in some of the other presentations, every community college is different. And so one needs to be careful in comparing between colleges, but oftentimes comparing yourself to another college, there's something to be gained, to be learned about why the difference, to make sure you understand and are content with that difference. And then comparing your own college's indicators over time can also tell a story that may be missed if you're just looking at a point in time. One set of financial ratios and indicators is produced formally each year by the coordinating board, and it's called the financial condition analysis. This was begun for many of the reasons that I've already expressed. It sets some benchmarks, and it lets us compare between colleges and over time. And then finally, there are other financial ratios and indicators that may be more informal, may be more internal to your college, but can also be meaningful in explaining what might be happening at your college. We'll focus most of the time on the financial condition assessment, a report that the coordinating board produces annually. It began in 2008, and it was based on an index that resulted from research that KPMG and some other research elements completed. Another thing to keep in mind, and you may have heard about these two standards, but the Governmental Accounting Standards Board produced two standards, number 68, which took effect in 2015, and number 75, which took effect in 2018. And basically what both of these did was transferred some retiree benefits, future liabilities for those on the community college's books. For example, TRS is the teacher retirement system, is what we use for our retirement. And they're the ones that are legally responsible for paying retirees benefits over time until they die after retirement. However, there is some thought that that needs to be distributed onto the college's books to more fairly represent where that came from. And the part that's effectively transferred to the colleges is that part that's considered to be unfunded at the present moment. That began in 2015 and had a huge impact on each community college's net assets. In 2018, a companion thought takes the future value, the future liability of all health insurance premiums for retirees and records that on the community college's books as well. Now, while the colleges are basically responsible for paying that, recording the lifetime premiums on a retiree is like recording a mortgage, for instance, on your personal financials. It's not something that the college will ever have to pay at one time. So as you can imagine, recording those two huge liabilities, future liabilities related to retirees, took a heavy toll on many colleges' net assets. And in fact, many of them became negative in their unrestricted net assets due to these two statements. So to enable measuring fiscal health on a very operational sense, the effects of GASB 68 and 75 are removed from the financial reports that the coordinating puts out annually. So if you were to look at your college's financial statement and you were to look at the report from the coordinating board, you may see some different figures, and that's why the effects of those two accounting entries are removed. There's 6 major indicators that are calculated, and there's minimum or maximum scores that are set on each one by the state. An overall score combines 4 of these indicators into what's called a composite index. So that composite index becomes the 7th indicator. Meeting 4 of the 7 minimum scores indicates that there is moderate to no financial stress at a college. Meeting less than 4 of the scores could indicate that there is some financial stress at the college. And you can see over time, since 2014, so the last 6 years I'm displaying here, there's been anywhere from 2 to 4 colleges that met less than 4 indicators. So stated another way, between 47 and 46 colleges annually are considered to have little to moderate stress. We'll start with the first indicator. It's called the primary reserve ratio, and it really tries to answer the question, how long can the college survive without additional net position generated by operating revenue? So in other words, it's taking your net position, which out in the normal world, non-government world, might be called retained earnings, and seeing how long can you pay expenses and the interest on your debt without generating any more net revenue. And you can see that the standard that's been set by the coordinating board is 0.14 would be the ratio that they're looking for, anything above that. And you can see down at the bottom that the average has gone in from 0.44 to 0.51 over time with a little steady increasing slope. And that on the latest year that we have a report on, which was 2019, that standard of 0.14 was met by 47 out of the 50 colleges. Another thing to notice that the four indicators that are averaged together to make the composite score are not valued similarly, meaning that if you see right here in the title, this statewide primary reserve ratio is 35% of the composite score of each college. Financial indicator number 2 is called the viability ratio, and it also is 35% of the composite score for each college. The viability ratio is asking how much of the debt can the college pay off with existing resources. So it's taking your net position and dividing it by non-current liabilities, but it excludes general obligation debt. If you're not familiar with general obligation debt, that debt is directly backed up by property taxes. And so it's looking for other types of debt. You may have revenue-backed debt and other types of debt, long-term leases and things like that, and wants to know how long can you go paying those liabilities without generating any more income, any more net income. Again, the standard is set at 0.42, and you can see that the colleges in general have vastly exceeded that, with 1.22 being the ratio back in 2015 up to 151 as the average in 2019. And in fiscal year 19's report, the standard was met by 44 out of the 50 colleges. Financial indicator number 3 is called return on net position. And it's really trying to answer the question, is the college better off financially now than it was a year ago? So it would be your change in net position divided by your total net position at the beginning of the year. So basically, how much money did you make this year? It seems maybe an odd question because we're really not in the business to make money. However, we do try to not outspend our revenues. You can see that this return on net position is 20% of the composite score for the year. And like the others, there's a standard positive return that's set at 0, meaning the expectation is that the college will at least break even annually. But looking at the actual operating results, you can see that the return on net position has grown on average from 5.4% in 2015 to 7.3% in 2019 for the 50 colleges. And in the last year reported, the standard was met by 42 of the 50 colleges. And then indicator 4, which is the last one that's used to average in for the composite score, is the operating margin. It's a similar question. Did the college balance operating expenses with available revenue? And depreciation expense, although it's not a cash expense, is included in this calculation. And this accounts for 10% of the composite score. Again, they're looking, the standard is looking for a 0, meaning that you do not have more expenses than you have revenues. Operating margin that was actually experienced statewide started at 5% in 2015, and this one actually trended downward to 3.5% in 2019. And in that latest year, the standard was met by 30 colleges. And so this is a good example of why you have to be careful with ratios. This might look negative. It might look like maybe people aren't paying attention or mismanaging, overspending, but many colleges save, and they don't want to go into debt. They want to do a small capital project. They want to do a $5 or $10 million capital project, and so they save over time for it and then expend it. And so putting too much emphasis on one current year's operating expense can be misleading. And that's one of the reasons that I mentioned earlier that you may want to look at a number of years in a row, 5 at least, if you're looking at your particular college, before you draw any conclusions, because sometimes what you see is just an irregularity that was actually planned for. Indicator 5 is important, but it's not one of the ones averaged into the overall score, and it's called the equity ratio. Does the college have sufficient capital resources available, and does it have the ability to borrow? The ratio is net position divided by total assets. And you can see that the standard that the state is looking for is 20%, and the average has been anywhere from 48.8% to 51.7% over the last 5 years. So that one is easily met by 48 of the 50 colleges. And then the 6th indicator is called the leverage ratio, and it's fairly similar, but it's talking again about debt and capitalization. It's what is the amount of debt in relation to net position. And again, this excludes general obligation bonds. So it's long-term debt divided by total net position. The standard is looking for something less than 2. This one has a max instead of a minimum score. And you can see that the standard statewide average has gone from 0.30 down to 0.21 over the last 5 years, which is a positive turn of events. And last year was met by 49 out of the 50 colleges. And then finally, the composite score is a combination of the first two. And you can see, I'm sorry, on the bottom, it says 20%, but the standard is actually 2. And 40 of the colleges met the composite score in 2019. And the statewide average is steadily increasing. You can see it was 3.4 back in 2015, and it's at 3.8 in 2019. And then finally, there's some college-wide operational measures that you might want to pay attention to as you're sitting in board meetings and hearing presentations. Many measures may not seem to be tied to finances, but if you're sitting with the CFO's hat on, most every measure that you see is somehow tied to finances. The real question is to understand basic data and changes over time and the possible impact on financial health. So I'll just give you some examples. One example that's not, I don't think you'll see published anywhere, but I like to look at within my college is, what is the cost to produce a completer? This is generated from internal data, but what was our total unrestricted budget for, pick a year, 2018? And how many associate degrees and certificates did we grant? And just divide those two. We may find that it cost us $20,000 per completer or some number like that. Looking at that over time is meaningful, and it can show you that your unrestricted budget is growing or not, but it can also show you that perhaps your number of associate degrees and certificates is dropping, and so it makes it look like you're paying more per degree when actually your costs aren't going up, but you're just not doing very well in your associate degrees and certificates. But looking at numbers and kind of different combinations can also incite a meaningful conversation. Number 2, what's the fill rate for your face-to-face classes and your online classes? Dr. Miller talked about the cost for adjunct and overload versus full-time instructors, but the fill rate also has a heavy impact on cost. If most of your face-to-face classes are set up for 25, but the average one only has 15 sitting in it, then you can see that your cost is much higher than it has to be. And sometimes our ability to fill classes has to do with the size of the program, the size of the college, the size of that particular campus. In general, an online class is expected to have a greater fill rate because it's not so dependent normally on time of day or being able to meet a schedule. But this is one area that can bear some scrutiny and maybe some improvement sometimes, and definitely has a financial impact. Another measure that the coordinating board puts out each year is in their annual report of fundable operating expenses. What they do is take all those expenses that, although the state does not 100% fund our financial activities related to instruction and student services and a few other areas, it does come up with and calculate a statewide average per contact hour. So for every contact hour that was taught in the state in 2019, collectively, the 50 community colleges spent $12.64 per contact hour. It's an interesting report to look at. It comes out in March each year, or February or March. And it's interesting because each discipline is also costed out. So while perhaps my college's average might be right on that $12.64 per contact hour, English may cost me $5.32 and welding may cost me $15. So there's 31 different instructional disciplines and they're all costed out. And you can see all 50 colleges' data. You can see the state average and you can compare your college. And that doesn't mean someone's better or worse if they cost more or less. It just means you need to understand the differences. And the differences may relate to the size of the program or may relate to the area of the state you live in or some other factor. And then finally, another interesting one to look at is student performance measures. LBB has this annual report and it talks about things like course completion rates, transfer rates, degrees awarded. But all of these things have an impact on cost or reflective of a conversation that you may want to have with some of your administration that has to do with cost. And those are just some examples on this last page. As you're going along, you may ask those questions in board meetings as you look at various reports and just say, what cost impact does this data that you're presenting to me today have? Thank you.